As the global landscape of cryptocurrency continues to evolve, significant shifts in regulatory approaches and market dynamics are unfolding. Recent developments highlight the balancing act that countries are performing between fostering innovation in digital assets and addressing the risks associated with their misuse. This juxtaposition is particularly evident in the contrasting strategies of nations like China, which is grappling with criminal crypto caches, and others that are enlisting industry giants like Binance to shape their regulatory frameworks. In a notable turn, Chinese authorities are currently deliberating on how to manage substantial caches of cryptocurrency linked to criminal activities. The debates stem from a growing recognition of the need to address illicit financial flows without stifling the burgeoning digital economy. With the Chinese government historically taking a hard stance against crypto trading, this reconsideration signals a potential pivot towards a more nuanced regulatory approach. According to sources, the discussions are focused on establishing protocols that not only mitigate risks but also allow for the legitimate use of blockchain technology. On a different front, Binance, the world's largest cryptocurrency exchange, is stepping into the role of advisor to various governments, assisting them in developing their own digital asset regulations. Richard Tang, the CEO of Binance, revealed that the exchange has seen an uptick in requests from countries eager to craft regulatory frameworks in light of the increasingly favorable crypto environment in the United States. The Biden administration, following Trump's initial embrace of cryptocurrency, has sparked a renewed interest among international jurisdictions to establish robust regulatory standards. Tang remarked, compared to many other jurisdictions, the U.S. are way ahead on that front, reflecting the perception that the U.S. is leading the way in creating a structured approach to digital asset governance. This advisory role comes in the wake of Binance's own tumultuous history, including a guilty plea to U.S. criminal charges and a hefty penalty exceeding $4.3 billion. The exchange aims to rebuild its reputation by emphasizing compliance, with nearly 25% of its workforce dedicated to this area. Tang noted the company is now in a form and shape that regulators appreciate much more compared to the past, a clear indication of Binance's commitment to aligning with global regulatory expectations. Furthermore, Binance's involvement extends beyond regulatory advice. It is also assisting countries in establishing national strategic reserves of digital assets. This initiative aligns with a broader trend where governments are starting to view cryptocurrencies like Bitcoin not merely as speculative investments but as strategic financial assets. The idea of a U.S. strategic Bitcoin reserve, although met with mixed reactions from traders, has fueled discussions on the potential of cryptocurrencies to serve as alternatives to traditional fiat currencies. Meanwhile, as Binance navigates its regulatory challenges, the broader crypto market continues to react to evolving sentiment and policies. Recent reports indicate that despite the initial excitement surrounding potential initial public offerings (IPOs) within the crypto sector, a market slump has dampened investor enthusiasm. Analysts suggest that the volatility in crypto prices, particularly for major currencies like Bitcoin and XRP, underscores the necessity for clearer regulatory frameworks to foster sustainable growth. In conclusion, the intertwined narratives of crypto regulation and market dynamics underscore a critical juncture for the global cryptocurrency landscape. As countries like China seek to manage the darker corners of crypto usage, and as Binance positions itself as a key player in shaping regulatory frameworks worldwide, the outcomes of these efforts will likely have lasting implications. The future of cryptocurrency will hinge on how effectively governments can balance innovation with the need for oversight, ultimately determining whether these digital assets can achieve their potential as mainstream financial instruments. In a significant pivot for the cryptocurrency landscape, Binance, the world's largest cryptocurrency exchange, has stepped into an advisory role for various governments looking to shape their digital asset regulations. This move comes in the wake of evolving regulatory frameworks in the United States, particularly under the administration of President Donald Trump, who has advocated for a more crypto-friendly environment. Richard Tang, Binance CEO, highlighted that the U.S.'s recent policies have inspired other nations to take proactive steps in establishing their own digital asset regulations. Compared to many other jurisdictions, the US are way ahead on that front, Tang remarked, underscoring the growing global interest in cryptocurrency governance. Binance's advisory role is particularly noteworthy given the company's tumultuous past. In 2023, it pleaded guilty to U.S. criminal charges which included money laundering and violations of international financial sanctions, resulting in over $4.3 billion in penalties. Following these events, Binance's co-founder Changpeng Zhao stepped down, with Tang taking the helm. Despite ongoing investigations, including a deepening probe by French authorities into potential violations of European money laundering laws, Tang asserted that Binance has made significant strides in compliance with nearly a quarter of its 6,000 employees focused on these efforts. The exchange's recent engagements with countries like Pakistan and Kyrgyzstan to assist in developing crypto regulations point to a burgeoning trend among nations to establish national strategic digital asset reserves. Tang noted that numerous governments and sovereign wealth funds have sought Binance's expertise in this area. This strategic pivot is further supported by Trump's recent directive to establish a U.S. strategic Bitcoin reserve aimed at positioning the country as a leader in digital asset management. However, traders were left wanting more, as this announcement did not include plans for large-scale government purchases of digital assets. The shifting regulatory landscape in the U.S. has also led to the Securities and Exchange Commission pausing its investigation into Binance and its U.S. arm, a sign of potential thawing relations between the exchange and American regulators. Tang expressed optimism about this development, stating, "I think the sentiment has shifted a lot as the company works towards establishing a formal global headquarters, a significant strategic shift from its previous operations." As Binance navigates its complex relationship with regulators and expands its advisory footprint, the broader cryptocurrency market remains volatile. Recent data suggests that Bitcoin, often touted as digital gold, has not provided the stability investors hoped for amid economic uncertainty. Instead, it has closely mirrored the fluctuations of traditional markets, raising questions about its effectiveness as a hedge against market downturns. Notably, while Bitcoin prices have plummeted, gold has surged, reaching new all-time highs as investors seek safer assets. Looking ahead, the interplay between regulatory developments and market dynamics will be crucial in shaping the future trajectory of cryptocurrency. As Binance continues to position itself as a key player in advising governments, the outcomes of these engagements could have lasting impacts on the global regulatory landscape for digital assets. The ongoing evolution of cryptocurrency regulations and market responses will be critical to watch as they unfold in the coming months. In a surprising turn of events within the cryptocurrency landscape, meme coins such as Fartcoin, Doge, and MEW have emerged as significant gainers amid ongoing discussions surrounding the potential purchase of Bitcoin by the Trump administration. This development comes as the U.S. government evaluates the ethical implications of its engagement with cryptocurrencies, particularly as it relates to tariffs and revenue generation. Recent insights from Bo Hines, the executive director of the Trump administration's Crypto Council, suggest that the government is considering leveraging tariff revenue to acquire Bitcoin. In an interview with prominent crypto investor Anthony Pompliano, Hines indicated that the administration's strategy could have profound implications for the market. If the government channels even a small percentage of tariff revenue into Bitcoin accumulation, it would encourage institutional investment and could trigger a bullish market response, Hines stated. The potential for increased government involvement in the cryptocurrency market is underscored by projections from the White House, which suggest that a mere 10% global tariff rate could contribute an additional $728 billion to the U.S. economy. This influx of capital could further legitimize Bitcoin as a viable asset class, reinforcing its status as digital gold. Analysts predict that this could push Bitcoin prices towards an unprecedented $300,000, a figure that now appears increasingly attainable in light of the Trump administration's bullish stance. Fundstrat CEO Tom Lee has revised his Bitcoin price predictions, stating Bitcoin's trajectory is on an upward spiral, and the prospect of U.S. government support is monumental. We could see a price of $150,000 to $300,000 sooner than we think. Such optimistic forecasts are bolstered by technical indicators demonstrating bullish patterns, including a cup and handle formation reminiscent of historic price movements in gold and the S&P 500. In parallel to these developments, new meme coins are gaining traction, with BTC Bull gaining particular attention. This innovative coin is designed to reward its holders with free Bitcoin airdrops whenever specific price milestones are reached. With a pre-sale that has already raised nearly $5 million, Bull is seen as a speculative yet potentially lucrative investment, especially as it seeks to capitalize on Bitcoin's expected price appreciation. However, as the Trump administration appears poised to expand its Bitcoin holdings, concerns about potential market manipulation and ethical considerations arise. Questions about the implications of a government-backed Bitcoin acquisition strategy are at the forefront of discussions among regulators, particularly in light of the U.S. Securities and Exchange Commission (SEC's) ongoing scrutiny of the cryptocurrency sector. As the landscape evolves, the interplay between traditional financial systems and cryptocurrency is becoming increasingly complex. The upcoming months will be critical for both Bitcoin and meme coins like Fartcoin, Doge, and MEW as the market responds to government moves and shifts in investor sentiment. The future of cryptocurrency could be significantly shaped by how these dynamics unfold, potentially ushering in a new era of digital asset acceptance and integration within the broader financial ecosystem. In the ever-evolving landscape of cryptocurrency, the performance and development dynamics of leading blockchain platforms are crucial indicators of future trends. Recently, Ethereum ETH has found itself in a precarious position, grappling with a significant price decline, while its competitors such as Solana SOL and Cardano ADA have shown more resilience. This shift raises important questions about the future of Ethereum, particularly in terms of developer activity and its implications for investment decisions. Over the past year, Ethereum's price has plummeted by 48%, contrasting sharply with Solana's impressive 32% gain and Cardano's modest 7% loss. Despite this downturn, Ethereum's ecosystem remains a focal point for developers. According to data from Sentiment, Ethereum logged approximately 2.1 million developer activity events over the last 12 months, significantly outpacing Solana's 463,600 and Cardano's 391,600. This stark difference underscores Ethereum's status as a primary destination for blockchain innovation, suggesting a foundational strength that could bode well for its future. However, this larger volume of activity does not tell the whole story. While the absolute number of developer events is substantial, the growth trends reveal a more nuanced picture. Ethereum's developer activity has risen by just 2% in the last year, a stark contrast to Cardano's 15% increase and Solana's nearly 18% uptick. Additionally, Ethereum's activity has actually decreased by 8% over the past 6 months, while Solana saw a 13% increase. This decline may reflect growing frustrations with Ethereum's persistent issues such as high gas fees and slower transaction times, which could be driving developers to seek more efficient alternatives. The implications of these trends are significant for investors. A decline in developer activity can lead to fewer new applications and a diminished competitive edge, particularly in emerging sectors such as decentralized finance and artificial intelligence. As Alex Carchidi of The Motley Fool notes, fewer developers mean fewer new applications launching and a smaller chance that the chain is the favored place to do business. This reality raises the stakes for Ethereum, especially with Solana positioning itself as a formidable competitor. For potential investors considering whether to allocate funds to Ethereum, the current climate presents a complex challenge. While Ethereum's established ecosystem and developer base are advantages, the downward trend in developer activity and the competitive rise of Solana and Cardano cannot be ignored. As Carchidi emphasizes, keep an eye on these trends. It may also be the case that talent and effort are flowing out for good. Such a scenario would signal deeper issues for Ethereum's long-term viability. As the cryptocurrency market continues to fluctuate, the coming months will be critical for Ethereum. developers may flock back to the chain if new updates address existing challenges. But the risk remains that the current trend could solidify a shift in allegiance towards faster and cheaper alternatives. Investors are advised to remain vigilant, monitoring these developments closely, as they could greatly influence the future trajectory of Ethereum and its competitors in the blockchain space. In the rapidly evolving landscape of cryptocurrencies, notable shifts are taking place as various platforms jockey for position amidst fluctuating market conditions. Recently, Ethereum has emerged as a standout performer, showcasing metrics that signal its potential to outshine competitors like Solana and Cardano. However, with recent volatility in the crypto market, investors are left pondering whether now is the right time to buy. Ethereum's recent performance is underscored by its impressive resilience compared to other altcoins. As of mid-April 2025, Ethereum's price had settled at $1,571.61 after a drop of 4.4%. Yet it remains a beacon of stability in a market characterized by significant losses elsewhere. In contrast, Solana, once a promising contender, has seen its price fall by 5.6% to $125.32 amidst broader market declines affecting many digital assets. The current market dynamics reveal a stark contrast between Ethereum's relative stability and the struggles of Solana and Cardano, each experiencing declines of over 5% within a 24-hour period. Cardano's price fell to $0.6031, illustrating the challenges altcoins face in attracting investor confidence. Amidst these declines, there are glimmers of hope for Solana. The approval of Solana ETFs for spot trading by Canadian regulators has sparked optimism despite the absence of similar moves in the US. This development is particularly significant given Solana's recent struggles with scandals surrounding certain meme coins. Such regulatory advancements could provide the necessary momentum for Solana to regain its footing, especially as institutional interest appears to linger. For instance, real estate financing platform Janover recently acquired $10 million worth of Solana tokens, signifying continued confidence in the ecosystem. Conversely, Ethereum's position is bolstered by its robust metrics and institutional backing, contrasting sharply with Solana's more precarious situation. Data indicates that Solana's decentralized exchange DX volumes have recently surpassed those of Ethereum's Layer 2 solutions, suggesting a potential rebound in trading activity. Analysts have noted a 16% gain over the past week in Solana's DX activity, supported by a substantial increase in deposits on key applications within its network. Despite these promising signs, challenges remain. Solana's native token SOL is still down 57% from its all-time high, and analysts caution that a broader lack of institutional interest could hinder any significant price recovery. The recent downturn in venture capital funding, which has dropped by 50 to 60% compared to its 2021 to 2022 levels, particularly impacts the altcoin sector, including Solana. Looking ahead, the cryptocurrency market is poised for further developments. As regulatory landscapes evolve and institutional interest fluctuates, platforms like Ethereum may continue to solidify their lead, while Solana and others aim to navigate through these turbulent waters. The anticipated approval of a Solana spot ETF in the US could serve as a pivotal moment for the ecosystem, spurring renewed investment and interest. Yet until external catalysts emerge to invigorate the market, particularly for altcoins, the path forward remains uncertain. Investors will need to remain vigilant, balancing potential gains against the inherent risks of a volatile market.